to the Tuesday, March 10th, 2026 Clean Water Services Board of Directors work session. This is Chair Catherine Harrington. I'm joined by Vice Chair Director Willie, Director Pam Treese, Director Nafisa Fai, and Director Snyder. So we have a full complement. The first item on our agenda is the rate study discussion. And we now have our staff and presenters. Welcome.
Good morning, Chair, and good morning, board members. I'm Kathy Leader, Chief Financial Officer for Clean Water Services. And the topic we're going to be talking about today, this is the progression of the last time we met in November, and we talked about our updates to the cost of service study for Clean Water Services. As a reminder, back in 2001, this was the ask of the board and the cities that we reevaluate our two utilities, sanitary and stormwater, and our regional and local programs, and make sure that we were effectively funding all of those different programs. That was the ask. And so we brought forward then to you the cost of service study that was based on detailed interviews with all our different programs and identification of ways to allocate costs that was equitable and made sense. Today, we're going to first give you an overview of our regional and local services, just to provide an understanding of those key different services provided by the district. We're going to give you an update of the cost of service study as we go forward with then with the rate projections and financial plan. We utilized the cost of service study with 26 budget numbers in there in order to do that analysis. I will then turn it over to Kim Baylor with Martel Wells. They helped us with the rate development and model and the financial forecasts that we'll be presenting. And we'll end with some rate comparisons showing how our rates still compare with others within our competitors and jurisdiction. And then we'll go to next steps. The first one to talk about our regional and local services. What we thought was this map would really help show our service area. So the gray area that's in the dark boundaries, that is Washington County. And inside of Washington County, we have our service areas that include the light blue areas that are where we provide regional services. These are cities that have their own utilities, and they provide their local service along with and they bill our regional rate. So those are cities like Forest Grove, Cornelius, Hillsborough, Tigard, Tualatin, and Sherwood. We also have in the yellowed areas, these areas where we as Clean Water Services bill customers directly for services. So that includes a local service for them and the regional component that we bill throughout our service area. So there's the unincorporated areas of Washington County, and then also some of the North Plains, Gaston, King City, and similars. So regional services, like I mentioned, regional services are billed to all of our customers, and they're provided to all of our customers. They include that construction, operating, and maintenance of the treatment plants and pump stations, along with pressure lines, and design, build, and maintenance of our sewer lines 24 inches and larger. We also do the compliance reporting oversight for the National Pollutant Discharge Elimination System permit, NPDES permit, including the separate storm sewer system, MS4. We maintain minimum stream flows in the region, and our service area restoration has some stream corridors. So those are the regional services that we were talking about. Local services, these are the services, like I said, with Clean Water Services provides and bills directly to the unincorporated urban areas of Washington County and the cities of Banks, Durham, Gaston, Kingston, and North Plains. These services include operating and maintaining local collection systems and 24-hour response. So it's design, build, maintain, and repair sewer lines 21 inches and smaller, and cleaning and inspecting the sewer lines, and the design, build, and maintaining and repairing local stormwater facilities. So that includes like street sweeping, maintaining water quality facilities, and clean catch basins and water quality manholes. as I mentioned, back in 2021, we started this update of the cost of service study. It was a comprehensive review of all the different programs that the district provides and identifying the types of services by utility and the regional local, and then establishing a methodology to allocate those costs. The full update, now based on 26 budgeted numbers, was completed by Bartow Wells in February of this year. And it's the basis of now setting our rates and determining our long-term financial plan for the district. With that, I'm going to turn this over to Kim Baylor with Bartow Wells.
Can I just start?
Sure.
On this study, I was surprised to see the last one that we done was 2008, so we seem to be a little bit behind here. But so have we established kind of a baseline of, so when we look forward to this every couple of years or whatever the case is, we have the baseline and we just look at, are we still evaluating the expenses for local and regional accurately? So we've kind of got a footprint of going forward. We won't have to do quite as comprehensive a study, but am I saying the right things here?
Yeah, definitely. Now that we have a strong financial plan, we're going to update that every year with actual experience, and then we're going to also every 3 to 5 years evaluate. Unless there is a significant change in program, we will evaluate our allocation between the different utilities and regional local services, and then and update potentially rates based on that.
It helped me, Director Willie, to use the word methodology versus the rates.
Oh, yes.
This is a top to bottom methodology. Looking at it and see if the methodology holds. So what they've decided is it's time for a methodology update. And then we apply that methodology year over year over year.
Yeah.
No more 13-year hiatuses.
Yeah.
Yes.
Because we have been changing the rates every single year.
Yeah, we have.
Based on that
Kind
methodology.
of unilaterally
Mhm.
with the broad brush.
Without a methodology.
Not without. No.
No, with the prior.
Prior, yeah, okay. I wanted to just clarify.
Yeah. And there was a big effort done previously to get clarity on regional versus local, because
Right.
regional had been subsidizing local way back then. So,
And on that map, I noticed that there are areas outside of the county
Mhm.
as well. And I recognize that that's CWS's work, but I just wanted to point that out for the public as well.
Ready? Go for it. Okay. I'm Kim Baylor. I have my colleague Eric Helgeson here in the audience. He came with me here today. He's local. He's in Portland. So I've been doing most of the work. He's been helping, but he's familiar, and he helped the district out in a couple years ago too.
so Eric, are you a Clean Water Services customer? Okay, that's okay. All water is recycled water.
Okay, so an overview of my presentation here is on this slide. So I'll give you just a little bit of background about Bartow Wells and who we are. Going to give you an overview of this study. We'll review the cost allocation, so the work that was done to allocate costs to sewer versus swim and regional versus local services. Also do an overview of the financial plan, talk about how we set reserve fund targets. Then we'll go into the details of the financial plans for sewer and swim separately, and then we'll look at the overall impact when we consider everything together to look at, what's the financial impact to customers and the district overall. And then I'll pass it back to Kathy to talk about next steps. So Bartow Wells is an independent public finance advisory firm. The firm was established back in 1964 in Berkeley, California. Our team is dedicated to doing utility, primarily public water, wastewater utility financial plans, cost of service studies, rate studies, capacity fee studies, which the district calls system development charges. So that's our business. This is what we do every day working with our clients. So to provide an overview of what we've done with this work, what we've done here from December 2025 to February, so the past 3 months, we provided we did a review and update of the cost allocation, which is how costs are allocated to the sewer and swim enterprises and the regional and local services within those enterprises. We prepared 10-year financial plans. The slide says five. We started with 5, but we pulled it out to 10 years to give you a more complete picture. So we looked at, in the financial plan, what the main objectives are is funding the district's O&M costs, debt service payments, capital improvement plans, correcting the deficit that exists when we're in the local services. So currently the local services in both sewer and swim aren't covering their fair share of costs. And so we looked at that and how we can correct that. We want to make sure the district has sufficient reserve funds going forward. We looked at a number of different funding alternatives and how to, look at rate adjustments in the future and project them out into the future and try to, help minimize the impact to ratepayers because everyone's sensitive to cost increases, right? And then we calculated updated rate schedules. So we'll show you the 5-year rate schedule for both sewer and swim. And then we're going to go over the customer bill impacts, how this impacts everyone and what they see on their actual bill on a monthly basis. So just reviewing the cost allocation, what we did was we took the work that the district previously completed and we used the cost allocation factors that were developed to allocate costs to sewer and swim, regional and local. We maintained those factors that were looked at a couple of years ago, and there was a detailed analysis that went into each program, and we looked at the prior work that was done. There is a report out there that I think you guys have seen, but looked at, okay, what is the work that the program does? How is it applicable to sewer and swim and regional and local services? So there was a big analysis that was done. So we maintained those factors that were developed back then, with the exception of new or restructured departments. So there's some restructuring that was done, and that for some of those programs, it was we applied a temporary allocation factor, but just like, for example, like research and innovation was 2 programs in the past. Now it's 1. So we just took the blended allocation that was developed for the 2 programs, put it into 1. And then for others, for completely new, there's a couple of new ones. We just took a look at, okay, what is this? What is the department doing, and what's a reasonable basis to allocate costs in the meantime before or until we can do a more detailed analysis? So we do have Kathy, Aaron, and I. There's a plan to look at a few of the programs to tighten up those allocations in the future. But so that's how. Hopefully, hopefully that's understandable. So we use the work that was done before, we're applying it to the future, and then we have some things we'll look at in more detail over the next few months.
I have a question for you about that.
What's that?
I have a question
Okay.
about the first bullet point in what you just said. Applied previously developed cost allocation. Are they relevant to the current
Yes.
environment too?
Yes.
Or is there an opportunity to change them? Or
Kathy and I can talk about it, but I'm very familiar with the work that was done back then. I actually did the work with the district, and I think I think we could go back and maybe look at some of the underlying data inputs that were used, because like for example, field operations, we looked at time tracking data for what those programs are working on, and it was based on like a 3-year period up until that point. So, we could go back and look at now, okay, is your time tracking data the same as it was back then? Or do we need to update it? So those are like little incremental increase, like adjustments that can be made over time. And my recommendation to the district would be look at it every 3 to 5 years, or if there is a major change in a program in the work that's being done. That's typically what we would recommend to our clients. Okay.
Yeah.
Does that answer your question?
Yeah, it did. And the reason why I asked that because the last time was 2008.
Yeah.
Like so many of,
Yeah.
things have changed, right? Like
Right.
not besides the pandemic and everything societal related, but just the growth of Washington County and who lives here has changed. So I was just asking that part of it. Like, have we grown,
Yeah. Yes. There's
and
been,
modernized our own cost allocations?
yeah, I think Kathy can speak to, how the district's changed over time because she's been there through that period. If you would like to,
Yeah,
like
and
speak.
and definitely that's the results of this study. What showed us exactly what we thought was happening. There was a shift between utilities costs for the storm program versus the Sandy program. So Sandy was subsidizing some of the storm program, so there's a cost movement there, and then also within regional and local. In particular, when you look at development services and field ops, they have a lot of activity that spans into that local area now, based on the study itself. So yeah, there has been this shift, and that's why you see this change in how we're doing the rate methodology and how we're adjusting the rates to recognize that we do need to true up and shift some of that cost and the rate over to those local programs and the storm.
Yeah, I think you'll see that, Nafisa, when we get into the rate discussion. And it gives a little bit of an understanding as to why there's considerable difference in the rate structure for one versus the other. But yeah, so that's a good backdrop. So thank you for that.
Yeah. Okay. Okay, so looking at capital improvement costs, the district has a capital improvement program, and the engineers that work on those programs, they do the work of allocating the costs to, figuring out what's a sewer project, what's a swim project, who does it benefit, regional or local or both, some share both. So we use that as the basis for how the CIP costs are allocated. And then for debt service, most of the debt service is allocated to the sewer utility because that's what the bonds that have been issued have funded is sewer infrastructure. And so debt service is allocated based on our previous look at how, what projects were funded with outstanding debt or outstanding bonds, sorry.
Well, besides that, Sandy's just more expensive.
Yes,
Mhm.
to process.
exactly.
Yeah.
Yeah, there's just a small share of the pension obligation bond that's allocated to SWIM. So the financial projections, like I mentioned, fund operating and maintenance costs, capital needs, debt service payments, maintaining adequate reserve funds, and correcting the funding deficit for local services. So to talk about our reserve funds, it's very important for the district to have reserve funds. The utilities are self-sustaining enterprises. The reserve funds allow the district to operate smoothly from a financial perspective throughout the year. Allows the district to meet unexpected expenses, revenue shortfalls, minimize debt financing, and improve its bond ratings. So if the district ever does need to go out to issue bonds, that's something that bond issuers look at, is how much revenue or how much cash the district has in reserves. That affects an interest rate that you'd pay. And the basis that we use for developing reserve targets are costs. So what's the level of O&M costs? What are capital needs? What is outstanding debt, and billing method and billing frequency? Oh, this slide is really, really looks better on my computer screen. So I'll
Okay,
just
we all have it.
okay. Oh, okay,
readable
great.
form.
Yeah, it looks better on a printed sheet. So I'm just going to flip to that page on my printed sheet as well. So these tables here summarize the cost allocation for the district overall. So this is in its O&M costs is what we're showing on this slide. So I'm showing what the O&M budget is for each department within the district's budget. So for fiscal year 25-26, the total O&M budget is 139.9 million. Overall, 83% of that is allocated to the sewer enterprise, 17% is allocated to SWIM. And then overall, if we consider regional and local, 78% is regional, 22% is local. The second table there breaks down how the O&M budget for sewer and SWIM separately is allocated to regional and local services. So for sanitary sewer, 85% of the service is 85% of costs are allocated to regional service, 15% to local, and on SWIM, it's 44% is regional services and 56% is local. So there's more work being done in the local system for SWIM than there is for sewer. And so this is used as the basis for developing the financial plan. So we take the
Oh, I see. Got a little mixed up.
yeah.
The 85-15 then is kind of
On the
a weighted average thing. How did you, if it's,
Yes. Yeah, you're correct. Yeah, it's weighted.
okay.
Yeah, so each department has a different, or each program has a different allocation. So it's not like sewer and SWIM are both 85-15.
Right,
Right.
right.
Does that make sense?
Yeah, that's what I was looking down the line, and then I got to the bottom, and it was 85-15. So I thought, okay, we can't just divide them all up.
Right. Right, exactly. Yeah, so if we start, we'll start, year one, sewer regional financial plan would start with like about $98 million in O&M expenses to start. However, we did reduce that by about 89%, or not by, we reduced it by 11%. So we're assuming that the district's going to spend about 89% of what is budgeted. So that is actually the starting point for year one in the financial plans. For
Not 85, is it?
No, she's talking about what percentage of their budget.
Okay, thank you. I'm sorry, I got confused.
sorry, it is a lot. It's a lot.
Trying to follow here.
Okay, so we'll start. I think. Where should I be
The
putting
on-off
this?
button on the side, did it get switched?
Oh, okay. Excellent.
My clicker's not responding.
Okay.
He switched it for you,
Okay, great.
back in the corner.
Okay, so then considering reserve funds, this slide here just explains, provides an explanation of what the district's reserve fund targets are. So both sanitary sewer and SWIM will have an operating reserve. And so what we're recommending is that the district holds 6 months in O&M costs for both sewer and SWIM.
And this is important for us to realize as compared to our county government role,
Mm-hmm.
where we have 4 months to bridge the tax collection season. And this, for the utility, best practices is 6 months for reserves, or operating reserves, sorry.
Right. Yes, operating. And then for the liability reserve, what we came up with was a reserve fund target that is equal to the CWS, the deductible for the general liability insurance, plus the 10-year average claims costs that the district pays out annually. Capital replacement, so both utilities, sewer and SWIM, would have a capital replacement reserve that is equal to the annual depreciation expense. To have a little reserve set aside for repair replacement type projects. For the SDC funds, so for both of them, we would recommend 1 year of revenue or the current equal to the current fund balance. However, I will say, like, we're setting that as the target, but those funds are available for projects if needed, when the district has them. For the LID construction reserve, so both utilities would have reserve cash set aside for that is equal to 1 year of project cost or the ending fund balance as well. And it's the same situation as SDC. Those funds are available to be spent on projects. The district should have a revenue bond fund that is equal to the annual debt service payment, which is required by your bond covenants. The goal with the construction funds is to build up to the average CIP expenses in future years, so that those reserves will be built up over time. And then a new reserve fund is for the contingency, which is equal to what the district budgets on an annual basis for contingency.
Question. I think what Chair Harrington pointing out about the operating made me think of, do we actually have a reserve policy for clean water services? And, okay. So-
I believe so.
And then what is it? I don't remember the 6 months.
It's always been 6
Doesn't-
months for the whole time I've been here,
Okay.
but it comes up just about every year during our budget committee meeting,
I was like 6 months.
which is why I'm trying to reinforce.
Thank you.
We wear two different hats. There's best practice as a county government versus best practice as a utility.
So this one,
Internalize that.
thank you, Chair. The 6 caught my, for some reason I was expecting less, but it's in the policy. I get it. Do you have a number for the liability, the CWS deductible for general liability just plus 10-year coverage? Do you have an
Yes.
estimation on that? No.
Yes, this slide here shows the actual numbers behind
Okay,
those.
okay.
So yeah, that liability reserve target is set to $5.5 million. So overall, the sanitary sewer enterprise minimum reserve fund target would be 284.1 million, and for surface water management is 30.6 million. Overall for the districts, that's $314.7 million is your minimum reserve target for the current fiscal year. And then going forward, what we've done is maintain that same level of reserves, but applied an inflation factor that, the same inflation factor that gets applied to expenses. So the operating reserve target would increase incrementally in the same proportion that O&M costs increase over time.
Could I pause for just a moment,
Sure.
Ms. Baylor? So almost $315 million, kind of eye-popping, right? It's on par with our general fund for a county government. But here's, I think, the key points for us to remember. As a utility, 6 months operating reserve. And if you look at the construction fund, there is a lot of construction that happens every single year. And so this is taking the tremendous work from our 5-year capital improvement program and, doing the calculation. So just to reinforce that these are very reasonable costs, these very reasonable numbers to put us in a positive position.
I think what you're pointing out is that for those of us that have worked with the county budget very intensely, these are such different animals. And the utility business is entirely different than the service focused industry. So I'm just underscoring what you're saying here, Chair, that it's very different.
Isn't our reserves higher than 314?
Yeah, they are now.
That's
Yes,
what I
yeah.
thought.
We are anticipating though with 2026, we will spend about 40 million of those reserves. And as we'll see going forward, the rate schedule we're set does show us using some reserves, but working to build them back up.
Right, okay. This is good information. If I could ask a question.
Yeah.
Just as a comparative, your graph of the previous one that's got all the numbers and everything else, how significant are these numbers different from what we've been using since 2008? I mean, were we really off the mark? Because I think And Jason, I thought I heard you say this, that the mayors believe that regional has been subsidizing local. And so I don't know that we necessarily want to emphasize that, but at the same time, was our analysis from 2008 to now reasonably accurate?
Well,
Changes.
Well, 2008, that was what the services were reflected when that study was done. That was the basis of the allocation, and it made sense with the two different utilities, regional, local. But over time, the service levels based on regulatory requirements and added infrastructure just have shifted those services. And so now this is more reflective now of that allocation that should happen. It just should have been evaluated sooner.
Yeah, no, I completely get that. I was just wondering how much change, we're going to
18 years is a long
See.
time.
It
Well,
is.
It is, and certainly the landscape has changed a lot in that time,
Yeah.
too.
So I think you're on top of it. There's the 18-year time frame, and there have, as Kathy touched on, there have been new regulatory requirements. And we've seen that just in our tenure in the last 7 years, as our team has helped us understand the complexity of the permits and the evolving, I'll call it the chemical composition that we have to manage towards. And so I think for me, those are the 2 points that I'm carrying forward. And as you've reinforced many times, but I'm still internalizing the rate of frequency in revisiting the methodology it'll be more frequent than what has been here the last 18 years.
Before we move on to the next section, I do have just a couple. I was going to hold them till the end, but I don't think that's actually the smartest thing to do given how many slides we have. So on slide 15, one question I have is about the capital replacement annual depreciation expense. I think we all kind of understand what that looks like in sort of normal, you depreciate something over 27 and a half years or whatever the depreciation schedule is. Many assets that we sort of account for that way actually have a useful life and typically last longer than the depreciation schedule. So I guess my question there is, do we need to do it that way? Especially if we know that something is going to last longer than whatever the sort of general government accounting practices are for depreciation of it, do we have to apply potentially a greater number?
Well, I would say that we do know we're over 50 years old. We do have a lot of repair and renewal projects that need to be done, and that's is helping to fund those. And so I feel like this is a good number currently with the level of work that we have out there to do.
I guess I would just make the observation that as we hopefully get a lot of that work done over the next decade, that probably should be reevaluated as to whether or not that, once you've maybe got a 2 or 3 year old car instead of a 15-year-old car, that as an analogy, that should be reevaluated.
And one thing I'll add to that in reviewing the depreciation, we over time have been being more deliberate in componentizing our assets and trying to identify the true life of the mechanics within an asset. So trying to get that depreciation closer to true life. And
Okay, so there's a specific effort around that.
yes,
That makes me feel much better. The other observation I would have on slide 15 is that it occurs to me when we're looking at the monster numbers that show up on slide 16 that we have healthy reserves for every area, and then we're also sort of adding a contingency to that. And I understand maybe the purposes are somewhat maybe a little bit different, but that does make me feel like we're doing a lot of saving. Just an observation. Like if you've got 6 months of operating reserve, for example, which I would say, yes, we're operating utility, but that's a lot. And then we're saying we're gonna have, you know, a $32.5 million contingency above, you know, a whole bunch of other reserves that are, you know, close to $275 million. Just seems like maybe double saving. Maybe.
Well, we're
Can I
definitely
ask a
gonna,
question?
yeah, we're definitely going to be monitoring
Okay.
our results of operations. But what you'll see from this presentation today is that currently under this existing plan, we are going to eat into the reserves down below the minimum. So it's managing that and over time.
Thank you.
There's also,
I'm sorry, just, and for the last budget, we had, what, a 10-year CIP?
Mhm.
That was presented in that budget, and I can't remember what the total number was, but it was a fairly large
It
number.
was,
And so, yeah, I applied that same methodology, Jason, to the list of capital projects that we're anticipating over the next 10 years, and it's a lot of money. So we're going to need to have
Yeah.
pretty significant
It
reasons.
starts with a B and not an M, right?
Yeah.
Exactly right.
there's also the issue of risk associated with this too.
Mhm.
And what does that profile look like in relationship to the reserves?
Any other questions so far? Okay, I think we're getting into the sanitary sewer rate plan now. So, your main financial drivers for the sewer financial plan are expenditures primarily. So on the capital side, the district has $554 million in capital expenses planned for the current year and the next 5 years. That's about $126 million on average. If we, divide that 754 by 6. Debt service, $17.1 million is allocated to the sanitary sewer enterprise for the 4 outstanding bonds that the district has. And then keeping up with operating cost inflation, operating maintenance costs. So what we have built into the analysis is an assumption that labor costs will increase at about 7% on average per year, and materials and services costs will increase by about 5% per year. And this is based on the district's historical cost inflation.
And that includes, that's an all-in labor cost,
Mhm.
perks,
Mhm.
health insurance.
Yes.
Mhm.
Okay.
And then that we need to maintain sufficient reserve funds.
Quick question,
Uh-huh.
Kathy, do we still have the Build America bond or did you?
yes, we do.
And is that in this list? that I don't
Yes, the
recognize?
2010B
Okay,
is a Build America bond.
thank you.
The CIP includes, is it 3.1%?
Inflation,
Inflation
3.31%. Yeah, construction cost inflation.
3.3.
It's tied to engineering news record, 10-year historical construction cost inflation.
Is there a more recent view? I'm just thinking about the escalating costs and how
Yeah, it
10 years would frankly reduce that average, I would guess.
with the construction cost inflation, which I was surprised because it's actually lower in the last few years than what I'm hearing clients talk about.
Yeah.
So I'm hearing from clients our CIP when we looked at our rates 5 years ago, what we're getting bids on projects for is a lot more. So I don't understand why the construction cost index might
judging
seem
that.
low, because that's
Mhm.
what I thought when I looked at it too, but that's the best data point we have. Unless the district has something else that we could use.
We always, DNR is typically what
Yeah.
we have.
And embedded in this is the cost of chemicals, the things that we've been informed about as far as increasing dramatically.
Maybe the other thing is the fact that we're in the next 10 years, we'll likely have a recession, right? I mean, that
Or those that would argue we're already there.
yeah, but I mean, just statistically, that would probably happen, and
Yes.
that would bring that number probably back to the mean.
Over 10 years.
Yeah. I think it's a reasonable 10-year assumption. It may not be in a single point in time or 2-year period.
Okay, so looking at the CIP in more detail for the sanitary sewer system, there's a chart up on this slide that shows the total CIP costs for each year. The dark blue bars represent regional projects, and the light blue part of the bar represents the cost of local projects that are planned for 2026 through 2031. So 90% of the sewer CIP is for regional projects, 10% is for local. And so this is what's built into the plan. And then beyond, because we looked at a 10-year period, so beyond 2031, what we did was we assumed that the district would maintain like the average level of spending that's here in this first 6 years.
I guess to me, it's assuming that we have historically been fairly visionary on our projected costs and projects. And so that's why we don't see a huge amount of money, some big spikes in there,
Correct.
and then letting it level out once we get past 31. We're not doing that. We're kind of saying this is what we anticipate. And then moving forward, there isn't any significant change. It's kind of the average. So
Right.
that would imply that we're being fairly prudent
Mhm.
in our CIP program. So.
Right. I wouldn't expect that you're letting a piece of infrastructure deteriorate to the point that it needs to be completely replaced, right? The district has done a good job of maintaining its infrastructure. That's what this says to me when I look at a CIP like this, rather than seeing one with huge spikes, right?
Yep.
Just out of curiosity, have we had a catastrophic failure of a pump station anywhere in the last 7 years? I haven't heard of anything.
And we're set up with redundancy and, you know, reliability and things in place. We've had a few, one issue with power, but nothing catastrophic, nothing that's caused a major overflow.
Yeah, the redundancy thing is very, sorry to jump
No.
in there, but the redundancy thing to me is amazing. That we have the ability to, we've got an issue here and we've got a backup plan
somewhere else.
here.
Yeah.
And so, yeah, again, another wise way of building a program, building certainly utilities.
That's what good utilities do.
All right. It's pretty amazing.
Good reminders. Thank you.
Okay, so now we're going to talk about the regional sewer financial plan and proposed rate increases. So this chart here on this slide shows a representation of full cost. So O&M, debt service, capital costs. So it's all of the district's costs for the next 10 years and compared to revenue with proposed rate adjustments. So the gray part of the bar represents the district's O&M costs. The yellow part of the bar represents the district's debt service costs. And the blue part of the bar represents the capital costs for the regional sewer system. And then the dotted black line represents revenue with rate increases. So what we're proposing is a 4%, or what looks like is needed is a 4% rate increase for your regional sewer rates in order to fund all costs and maintain reserve funds over the next 10 years.
I thought what was interesting to me in that is the little yellow band.
Yeah.
Because that implies that we're not taking on any more debt. We're just paying down the
Correct.
debt we have, and so that's also a good thing.
Yeah. Correct. Yeah. We're assuming that all CIP is going to be cash funded.
Correct.
Which Kathy's done a great job of with her staff over these years.
Now this does include that. Didn't we borrow 75?
We did not do the issuance this year.
Okay, and then the next slide, I'm going to show the local sewer financial plan and proposed rate adjustments. The chart follows the same format that we used for regional sewer. And what is needed is really a 21% increase on your local sewer rates for the next 6 years. And then after that, it would drop down to 5%. And then, you know, going forward, you'd probably see more inflationary level cost adjustments unless there's some significant change that, you know, we can't forecast right now.
This would only apply to the areas that are on that map in yellow.
Yellow.
correct?
Correct.
So the city, that whatever a city charges is irrelevant to this if you're inside a city that does not use CWS for local service.
They would charge the 4% regional, but
Yeah.
they would have their own local rate
Okay,
to cover
thank
the
you.
costs.
So hang on a sec. I get it. I'm following the math. What was our local rate percent increase the last couple of years?
We have consistently used the same increase across all of our utilities, regional and local.
Okay, so this new methodology breaks it out separate, more distinctly.
I
Now
would
I'm
say,
starting to internalize.
Because regional's been subsidizing
Right.
local
Yeah,
through that.
Yeah, and if, to answer your question, I think last year was 3%.
Yes.
Mhm.
And before that, we've been on a flat line 4%.
4%. Although I will say that SWIM has had a different rate adjustment in past years, but it hasn't differentiated between regional and local, just the SWIM program,
Oh,
because
yeah.
it needed to build its reserves.
But the end effect was still the 4%.
Yes.
Yeah.
Um,
Up until last year.
Well, the combined together was over 4 because usually like sewer would be 4, but swim would change like 50 cents. Remember, it used to be a set dollar amount,
oh, yes.
right? Because we were trying to build their reserves back up because they were actually operating at a loss. Yeah. So, but then the last few years we've increased across the board 4%, and then last year 3.
And what year was it that we had no rate increase? Was that 21, 22?
During COVID,
21,
Yeah.
I
First
think.
year of COVID, I think it
Yeah,
was 20.
20.
FY.
Yeah.
Yeah.
Just want to throw that out there for
Mhm.
Until Kathy
That
showed us the
aberration.
math.
So I understand the graph and the chart, but if you haven't explained it yet, I don't mean to keep you from that. I'm always a little sensitive about a phrase like excess revenues.
Well, yes, I was going to explain
Thank
that next. So the thing to note in this chart is that if you look at the first 5 years, up through fiscal year 2030, local revenue doesn't cover local costs. And so that means that those costs will be covered from the district's reserve funds. So that's part of the drawdown that Kathy mentioned earlier that will happen. And so in the later years, we kind of make up for that. So
Repay them.
this is
yeah,
this is
essentially,
plan.
yeah.
So what would that increase be if we were full cost recovery immediately?
You're looking at summing the 21% by 6 years. So, you're looking at probably doubling the rate, close to doubling the rate.
Yeah, the 21%, to your point, Jason, being for the local.
Blue.
Well,
Yeah.
21% is still a pretty hefty increase for our local constituents that are typically on smaller budgets.
Hmm.
So we probably have that in here. I just can't remember.
21%, but the overall dollar amount.
Yes.
That's what I was
Yeah.
looking for, is what the dollar impact.
That's, I think we need to make sure that, especially in these discussions where our public is watching, I think we
Right.
need to keep saying that piece as well.
Well,
Yeah.
also they're getting the cost efficiencies of such larger local areas.
Right.
The outside cities are getting quite an efficient rate service
Compared to what
because
they could do themselves. for
that's
sure.
right, exactly. Yeah. But you're right. If I go over to slide 14 and apply the dollars, the dollars are smaller for the 21%.
So if we consider sanitary sewer as one enterprise and we combine regional and local revenues and expenses, the product of that is on this slide. So, we want to make sure we're covering generally covering the district's costs overall for sanitary sewer. And so this chart here shows the sum of all the O&M, debt service, and capital costs, and sum of all the revenues for the regional and local side of the sewer. So we're about, first few years we're running a little bit of a deficit. Later on, we're making up for that deficit and repaying the reserve funds that we are spending. And here's the reserve fund chart for the next 10 years. So the blue bars represent the ending cash balance in all reserve funds for the sanitary sewer enterprise, and the black dotted line represents the minimum reserve target in each year. You can see in the first year, the district is projected to end with about $360 million in reserve funds that will be drawn down over the next 5 years and then built back up to the minimum reserve target at the end of the 10-year period.
And we do this over time for it to be smooth.
Right.
And that's really the essence of this too.
Yeah.
There's a lot of estimating that goes with this.
Yeah.
too, Like it's not super
But
precise.
it's rate shock that we're trying to avoid, and we're also trying to avoid shock to the reserve system.
Yes.
So it's
Yeah.
that balance.
Right. So, yeah, one of the purpose of having reserve funds is to provide a financial cushion to,
Mhm.
to do this, to not raise rates
Manage.
drastically 1 year, so people aren't expecting it. We can do gradual rate increases over time.
Could the other side of that be, on slide 21, I was actually thinking with slide 23 that perhaps we soften the blow and start incrementally, and start small, rather than start 21% all the way to sixth year, and then it goes down to 5%
Mm-hmm.
because of where we are
Mm-hmm.
as a society, as a community, and what's been like. While the dollars are small, still the percentage is pretty
Mm-hmm.
high. So how do we? I mean, I don't want to get ahead of your presentation, but sort of paint a picture that coincides to slide 23, where we start off a high, high number,
Mm-hmm.
and then the slide before that, 21, is saying let's start with 21%.
Mm-hmm.
And then after 6 years, it goes down to 5% because we have been. So I don't
yeah,
know if there's one of those scenarios you'll present later on, but
Yeah, that could be an option for the district to consider. Yes, is doing less than 10%, but doing a higher rate increase for a longer period of time. That could, because that's what would happen if we lowered the rate increase. We didn't do 21%. We did something less than that. Say maybe 16%. If we did 16% for 10 years, maybe that would get us there. I don't know offhand. I'd have to go back and work on the math.
That's a huge
little bit.
policy discussion because we're talking about shifting who's paying. I mean, there's already been a bunch of subsidizing happening, and perpetuating that is concerning to me. But I know that's not the purpose of our discussion right now. But
And there was a lot of political blowback with course correcting with the 2008
Mm.
improvements. So,
Well, I think, to your point, Nafisa, what is the dollar amount of increase per customer? at
we're going to get to
21%?
that with slide 24.
no, we're just
Two more slides.
yeah, no.
2 more slides. I promise.
Yeah.
I'll show
Well,
you
I
the
just
numbers.
remember Kathy, when I was debating her a year ago on, no, if we don't do a 4%, we just lose X amount of dollars. And of course, she proved me wrong. So, so I don't like
The win,
There
Gabby.
you go. Take what I can get.
I don't like to admit that publicly, but going to your point of the 21%, yeah, I'm guessing we'd be at 15 years if we dropped that 21% down a little bit and pushed it out. So it's kind of like ripping the Band-Aid off.
And let's look at the impact. I think that's where we are now.
Okay, so here is the rate table. So this would be actually your rate schedule for the next 5 years if the district adopted the rate adjustments that are proposed in the plan. It shows current rates are shown in the first column. Rates for the next 5 years are shown afterwards. So just some key numbers to highlight. The local base charge is currently $5.96 per dwelling unit per month, and that would increase to $7.21 next year, and then would be at $15.45 in 2031. So 5 years from now. The regional base charge is currently $30.41 per month, but would increase to $31.63 next year and would be at $37.01 in 2031.
So for example, from FY 26 to FY 27, the base local cost goes up by $1.25. So 21%, like we've been saying, is a small dollar cost.
So this slide here shows like what customers would pay on a monthly basis total on their bill. So, and this is for a residential customer, so someone with one EDU and is using an average of 8 units per water in the winter months. The regional bill component would increase by 4%, which is less than $2 a month. And the local bill component would increase by 21%, but that's also $2 a month because it's on a much smaller base charge. Overall, a customer that's in the local service area, their bill would increase by about 7% per year or $4 or so per month with each rate increase.
Any questions on this? Nope, keep going.
Okay. All right. Now we're going to talk about SWIM. So for the surface water management system, the main financial drivers for the financial plan there are funding capital costs. The district has about $11.8 million in capital costs for the current year and the next 5 years, about $2 million per year on average. There's a small share of the pension obligation bond that's allocated to SWIM, which is $360,000. That only goes for another couple of years. That's going to be paid off pretty quickly here. And then operating cost inflation, we're applying the same inflation factors that we did for sewer. So 7% increase on labor, 5% increase on materials and services, which is tied to historical cost inflation the district's seeing. And then also we want to maintain sufficient reserve funds for the SWIM system. This slide here shows the capital improvement program for SWIM. So it shows that nearly $12 million that's going to be spent and how that's spread out over the next 5 years. 76% of the costs are regional and 24% of the project costs are on the local side. Here is the chart that shows the regional SWIM revenue versus expenses, and then proposed rate increases as well. So what we're proposing on the regional SWIM side is a 4% increase on those rates. As you can see in the chart, the district will be covering its costs overall for the SWIM system in most of the years. On the local SWIM side, rate increases are projected to be about 5% per year. And in this case, you can see we're going to run, the district's projected to run a little bit of a deficit throughout the 10-year period, but there's sufficient reserve funds on the SWIM side to make up that difference. And so that's what we have assumed in the plan. Overall, here's the total revenue and expenditures for regional and local SWIM system. The district's projected to, just about cover its costs and use some reserve funds each year to to cover expenses in total.
So
Which
is
you
this
said is
just
being,
the swim reserve or is this the total agency reserve?
This is total costs versus revenue. So the bars represent costs and the dotted line represents
No,
revenue.
I get that. I'm
Okay.
talking about use of reserve funds.
Oh, sorry.
Is it the swim reserve?
Yes.
Okay.
Yeah, so we're keeping cash is separate for sewer and swim. So if there's a deficit in swim, then
Comes
the
from
swim
that
reserve will
bucket.
cover that deficit.
Yes, that's what I
and
just.
you have that planned out on purpose because there's more in there.
Right.
Right now, there's more than might be needed.
Yes. And so this chart here shows the projected reserve fund balance in the blue bars on the chart, and then the dotted black line represents a minimum reserve target. So, the district has more in reserves than to meet the minimum reserve target. So what we're assuming is in the analysis is that the rate increases can be lower on the swim side too. And we can draw that balance down over time.
So that slide 32 shows still, even at the end of 2035, a much larger ending reserve balance than is necessary. Why even the rate
Well-
increases that we're talking about?
We could do lower rate increases, but you're getting to the point where that deficit is going to be gone, or the surplus will be gone in a year or two. If revenues and expenses track the way that we're planning for in the plan within the next year or two, the
After
surplus will be gone.
2035?
Yeah,
The dotted line keeps going up and the bars go down.
right.
Mhm.
And there's a lot less capital
Mhm.
and operating on
Mhm.
the swim side compared
Right.
to the sewer side as well, right?
Right. Correct. So this slide here shows the actual rate table for, comparing current rates to proposed rates for the next 5 years. Currently, regional service charge is $2.82 a month and will increase to $2.93 in the next year and would be at $3.43 by the end of the 5-year period in 2031. The local service charge would change from $8.48 per ESU now to $8.90 next year, and then would be at $10.83 at the end of the 5-year period. And the next slide shows the bill comparisons. So, and I'm sorry I didn't highlight this when we were going over sewer, but the green bars on the left side of the screen show the regional bill component. That's changing by 4% per year and is really like 10 to 12 cents per month. On the local bill component, which is the yellow bars in the middle of the screen, that represents the bill in the first year and the next 2 years. Their bill is increasing by 5% per year and is like less than 50 cents a month. And then overall, someone in the local area that pays both the regional and local service charges, their bill is increasing by about 5% overall combined, or 53 to 57 cents per month. And then unless there's any questions, I'll get into the slides that show the overall, the district.
We're at time right now.
Oh, we need to stop?
Well, I
No,
don't
no,
know, but
no.
we gotta keep.
Power through. Okay. Good. I don't have to get another flight up. Although I would like to. Okay, so here, this slide here shows the district overall. So we're showing in the blue lines, the blue section of the bars represents sewer regional expenses. The green section of the bar represents sewer local expenses. The gray part of the bar represents swim regional, and the yellow part of the bar represents swim local expenses. And then the black dotted line represents, rate revenue with these proposed rate adjustments for the 10-year period. So, as we've discussed previously, we're not covering our costs in the first 5 years or so of the plan, but then we start making up for it later on. You can see, the overall impact to the district from a financial perspective. And I think the next slide Shows the reserve funds overall, so total cash in sewer and swim. Overall, we're over $400 million reserves to start. That balance gets drawn down over the next 5 years and starts building back up at the later end of the 10-year period.
I have a question. At FY 2035, that small differential is what Jason called out, or Director Snyder called out in the last slide as being 30 million. Is that right? Is that the differential?
It was only, well, I don't know if that's what's driving that, but what I was commenting on was only in swim.
Yeah.
Right. So I'm looking at,
Yeah, it's like I think it's like 13
I'm looking at the
million.
reserve. Yeah. Okay. I'm not comparing apples to apples.
So it may be part of that.
I'm just looking, I'm trying to roll up your comment to
Yeah.
the whole picture.
Yeah, when we blend, I mean, swim is very small, is smaller share
Right.
of the pie than sewer is. So it looks like there's a large surplus at the end of the 10-year period in cash in the swim cash chart, but if we consider it with the district overall, it's really not a huge dollar amount. And then if we look at overall bill impact, I think this slide really sums up like the overall impact that your customers will see on a monthly basis in their bill. Customer in the customer in the regional area, so only the large cities, they're going to see a 4% increase in their bill. That currently it's $49.39, and it would go up, by $2 per month with each adjustment. And then a customer in the local service area, so someone who pays both the local and regional bill components, they're going to see, less than a 7% increase in the next 2 years.
And we don't know what cities are doing.
Kathy does have a slide.
Okay, we do. Okay, thank you. I
don't know if we know like into the future. We don't have the projection.
We'll show you on that slide what we
okay,
do have.
I can wait. Thank you.
So this really concludes my part of the presentation. The district's been really proactive in the past in doing incremental rate adjustments over time, and so what we're trying to do is keep the district on a path like that for the future after correcting for the local funding deficit.
So we were asked at one point to show what would the impact of a 3% rate increase be over time. So we did map out that alternative. And
imagine who would have asked that question.
And based on current projections, this is showing you a 3% sewer rate increase. It's showing you then the bars are your overall total operating debt and capital costs, and the green dotted line is your rate increase over time or revenue increase over time. And it's just showing in this chart that it does not cover your operating costs in any given year. And it then does result in a spend down of the reserves for the sewer fund down to minimum levels down into 2035 that were below what we had when we issued debt back in 2009. So that definitely depletes those reserves.
But to that point, the question was really asked strictly about the 4% versus 3% increase for this year. It didn't take into effect the issues that we're trying to address with this new approach where we're looking at balancing our regional and local and all those other pieces as well. So I just want to call that out, that it was just about the impact that we were experiencing at that particular time at CWS across the board. So it wasn't influenced only by rates.
And next, we're going to speak to then some comparability. So we did reach out to some of the cities recently, and they're all really early in their budget processes also and have not yet published out or what they're doing with their rates. What we did to show if we are still competitive and comparable when you look at what we're proposing for our 27 rate, we mapped out what for the comparables in the region. We showed what they proposed in 26. So these are their 26 rates currently being charged, and we're mapping those against Clean Water Services rate increase at $71.23. And it really just shows that we are still competitive, and we know that there will be increases in their rates as they move forward with their 27 budget proposals.
And can you help me understand the volatility between the cities in terms of their rates? Is there much difference between that we currently experience?
We're talking about our competitive
No,
utilities,
I understand.
not our local
You're
city.
saying
Okay.
within our cities?
Yes, within our city.
And I'll show you that one
That's a
next.
different slide.
I'll show you that
okay.
one next.
I just wanted to see that too. Thank you.
Yep. And we'll show
I
you
have a
that.
quick question on that. That's like
Yeah.
Kathy, just so I'm tracking the numbers correctly. Clackamas County is with their 6.4% rate increase, they're at $9.55. Am I reading it correctly on them?
Well, one point on that. So for West, so Clackamas, Vancouver, Salem, McMinnville, all the other comparable cities, these are their rates they are charging right now in 2026. We don't know what they're going to be proposing in their 27 budget yet. So the only thing we could do is show you what they're doing in 26. We know then more than likely we'll have some increases, but how they compare to what we're proposing for 27. So it's just showing you that we're still comparable, knowing that they're also going to be increasing their rates
Oh,
in
right.
27 more than likely.
Okay, and then, so that would put us then with a 6.4% from CWS, 1183.
On
swim and
on
then
yes, on swim.
Sanitary,
Mhm.
59.
Mhm.
Is that, okay.
Yes.
And that dollar amount is with 6.4% increase
Overall.
Yes.
overall.
Overall. And then to George Priest's question, this similarly, we reached out to the local cities. They're all early in their budget process, do not have the rates they're planning for 27 yet. So what we show here is like, as you remember, they charge our regional rate. So we adjusted their 26 rate with our regional rate. So you see how the blue line all the way across is the same. That is our new regional rate that would be charged in 27. And then we layered on our rate for 27 based on this rate model, and we utilized their current 2026 local rate. And it's really just trying to show you that we still are competitive within the environment, and we know that they will be and more than likely adjusting their local component in the next year too. So we're staying competitive.
So just to reinforce a couple of things, you can see in the combined CWS with regional and local for the local CWS customers. So those in the yellow, they're continuing to get efficiency of scale. Okay. Then I also want to reinforce the 6.4 you can see comes from slide 38. Okay, so if it helps to reinforce where the 6.4 comes from.
And that's got just the obvious question is why is Cornelius so much higher?
Your
Yeah,
customers,
they have a smaller service area.
Oh,
They spread their costs over.
so we have another really small city, Durham.
If they were to try to do it, it'd probably be 3 times the Cornelius rate. Very inefficient.
Right. Yep. They're a yellow city, so they're the CWS bar on the left.
They could be much bigger in number.
They could.
Well, another way to look at it is look at Forest Grove versus Hillsborough.
Mhm.
what I get out of all that is that our small cities benefit greatly from this operating approach and get a great deal.
The local
Yep.
service cities.
Yeah, because they certainly couldn't afford to go on their own.
So before we go to next steps, this is a really good time for you to ask your final questions on the data.
I have nothing.
I've been asking mine. Thank you.
I just have a couple of comments. One is fantastic work. And I know it's been a long presentation, but it's been very helpful to go through it, which somewhat relates to my second comment. I don't envy your situation next year in having 2 or 3 new board members to take them through all this. I know it's going to be a lot, but in my viewpoint, you've done a really great job in this presentation alone. They haven't had the benefit of the multiple years of exposure that we have had to your CIP, to your excellence of level, but I think you have all the material that they're going to need. They may need a little bit more time to internalize, like the really great one graphs you have with the 3 different colors. Sorry, I can't find one real quick. The green, the blue, and the green, the yellow and blue.
Yeah.
But all the data is there. Thank you.
Well, and I think that just to emphasize that, Chair, from my standpoint, being able to differentiate the 2 different services in the 2 different areas that we've now clearly defined in this helps understand the overall clean water services operational picture and breaks it down into those boxes, which is much easier to comprehend than just looking at a facility saying, what are we doing here? And so this is good.
Which reminds me, I'm sorry, I do have something. Your next slide is on next steps for adopting this new methodology. But I need right now for you to reinforce verbally, which I think invites another slide before you go to that adopting next steps for adopting the methodology, is you're recommending that you revisit the methodology every 3 to 5 years.
Minimum 3 to 5, but if we have a major change in a program, we would implement.
I think put a slide at the end, put that slide in here, because you've given us the view of, so what does this look like over the 10-year horizon? That's stellar. Okay, and you have a really good recommendation, and I think your future board will really benefit from seeing that put down in a slide.
I do have a question. Does CWS 101 include a rate discussion? Rate setting discussion? Thank you.
No,
I'm,
you got the
I'm-
maps,
the back
you
of the
got
calendar.
you got all this stuff.
and I'm advocating for that. I think it's really important for those attendees. When I look at the profile of the attendees, I think it's really important.
Rate light.
It may
Call it
be
rate
important
light
to have
versus rate
a
101.
little bit of that for the budget committee this year too.
Oh, that's good. Thought. Mhm, mhm.
Okay. Next steps for adopting the methodology.
All right. So next steps, between now March and May, the district will be meeting and outreaching to the cities with our cost of service study and our proposed rates and financial plans. So we'll be reaching out to them over that time period. During that time period, then the board will, on April 14th meeting, adopt a cost of service allocation methodology that takes into account that now we are identifying individual utilities, Sandy Swim, and regional and local, and we'd be adopting rate increases based on those key different services levels. We're going to be producing a proposed budget that's going to include for the 27 year those proposed rates currently, and those will be distributed to the budget committee on April 17th. The budget committee will be meeting on May 8th to deliberate on the budget. And then June 9th, that's when we're going to hold the budget hearing itself, and you would be adopting the rates for that become effective July 1st, 2026. And as the chair has said, then as we go further out, we will then be updating these rates and methodology every 3 to 5 years.
So, if I might, and I'm sorry I didn't catch this previously, on May 8th, we've gotten a little crisper on the county side too. The budget committee meeting and its budget approval.
Yes.
Yeah.
Yes. Approval. Yes. Budget committee approves and the board adopts.
Yeah. Nope, we're all on the same page, but we're finding we need to document
Okay.
that transparently. That's any last comment?
I would say I have my own next steps identified, which is to follow up with all of you. And I might be the only one, but I think I'm kind of freaked out about the rate increase, the
Okay.
bit of the hike that is. But I do want to have more conversation with the staff and a bit more understand and see if there are some levers we can pull to pull that down significantly and see what we can do in the meantime and
Wait a second,
entertain.
that's a policy change.
No, I'm having a conversation with the staff to understand what are some of the built into this. So
So your request is to understand this material.
my request is to have a conversation with the staff to go in depth about what the work they did to get to the materials that's published right now.
Yeah, definitely.
Okay, good job.
Yes,
Thank you.
thank you
you.
very much.
You're welcome.
Tremendous. Okay, agenda wise, we're moving on then to director and leadership communication.
Would you like me to send those in? I know we're behind schedule and we have the executive session. Would you like me to send those in an email so we can make up some time and make sure you get a break
Great.
before the next meeting that you have?
I've got to sit in a board meeting this afternoon too, so I've got to go pretty soon as well.
Yeah, we'll be done at 11:20, but if it
A
serves
couple of things. We may need to go the full 40 minutes. So Brett, if you could send a heads up to Washington County staff that meeting may not start until 11:45 because we still have to have transition time.
Okay.
Thank you for the savings. So we will postpone item 2 unless there was some burning director.
The only thing I think we might need to talk about is the NACWA April.
That I'm a
Topic.
little confused about. If Elizabeth could come up because she sent us an email that I just read. I was under the impression that you were going to cover the NACWA fly-in from our last meeting.
So I had offered that. We then had the discussion coming out of that was we would revisit it now. Subsequently, I talked with, and I'm concerned, so I'm just be clear. After talking with county administrator, I'm concerned about missing, actually any of us, missing the budget session that night before. And I personally, so I did communicate this, I think, to Rick, that's concerning to me enough that my recommendation actually after having that discussion is that staff go.
Yeah. And with what you saw during our business meeting, that's
Yeah.
one reason why the doctors don't want me traveling
Yep. Understood.
in March and April.
So is there a message that we are going to be delivering while we're there with our legislators, or is it just kind of a meet and greet and say, don't forget about us, or?
So for the record, Elizabeth Edwards, Chief of Staff with Clean Water Services. We have been working behind the scenes with staff also to look at your calendar, look at different conflicts after we've received news from the chair and agree with Director Snyder's approach just to send staff this time around. The good news is we do not have a robust federal agenda. We have a few items, and we'll be looking at taking a few meetings potentially with other staff from, say, the Water Commission to thank the delegation for an appropriation that they put towards Goggins Dam. And also to hear some presentations from the EPA, Army Corps, FEMA, and others. But we're still pulling together the agenda in part because you get different meetings when you have an elected official with you.
Yeah, I think that's kind of where I was going there. Not that our staff probably deliver a more detailed, better message than we as electeds do because we're not quite so far in the weeds, but at the same time, making sure that we don't send a different message.
So another thought might be, as you go back there, if there are key issues that we need to go back on, we can, look at the future schedule as well. So,
And we will be preserving budget so that we can do that.
sure.
Great.
Yeah, we don't want to appear unengaged or
No.
uninterested.
Yeah, that's exactly right.
Exactly.
In terms of timeliness. And 4 of us were at the Bonamici meeting yesterday, and there was a reference made about the federal logging potential changes to the buffer, reducing from 100 yards,
Feet.
100 feet to 25 feet. And I'm worried about the forest lands, especially the private forest. The private forest lands that might impact the water clarity
Mm-hmm.
that we rely upon for fish habitat, let alone that JWC would rely upon for drinking water quality. So I just wanted to make sure I mentioned that today as something that I think we're relying upon you to track.
Tracy should be.
Yeah, and wondering
Mhm.
if that might come up in any meeting
Well, I
you
might
have with the delegate.
I might like to have a conversation with Tracy then, because I'm going to the Association of Oregon and California Counties, which is BLM lands. That's Friday, and we have the lobbyists plus attorneys and everything else going to update us on what this all means and where it's
Goggins
going.
Park, as you well know, is all BLM lands.
Right,
with
that's our
Rainbow
only
Creek.
little part of it that's BLM-ish. That's why we belong to this organization.
Yeah.
But yeah, so I'll be happy to bring back a little bit more of their perspective of where we're going with this. And just again, for clarity, remember that other than that little piece of BLM lands, all of our forest land is trust land. So that's state managed. And so there's a difference in how the rules impact those two forest areas.
Okay, so we're all set on that. Without further ado, then, I would ask for a motion to adjourn to Clean Water Services Executive Session pursuant to ORS 192.660 sub 2 sub D for the purposes of discussing labor negotiations. And General Counsel Lubdell, I think if I'm correct, press is also excluded from an exec. Okay, do we have a
So
motion?
moved.
Second.
We have a motion and a second. All those in favor, thank you very much. Any opposed? The motion carries unanimously 5-0. For the sake of time, we need to shepherd all of you out of